Hey guys, so today I'm going to be talking about somewhat of a controversial topic, and that is that I will never pay off my mortgage. That's right, I'll never pay it off. One of my many adventures is that I'm a real estate investor. I own this house and I have numerous rental properties. And all of my properties are on a 30-year fixed mortgage. I am making the bare minimum payments required. I'm not trying to pay these mortgages off rapidly. And in fact, down the road, once these mortgages get anywhere even remotely close to being paid off, I plan on doing a cash out refinance, taking equity out of that home and resetting the clock back to another 30-year mortgage. Now I know somewhere out there, Dave Ramsey and all the rest of his cheerleaders just had a collective heart attack. And I know that at least a few of you guys are going to put negative comments down below and give the video a thumbs down saying this is stupid. But before you guys do that, at least hear me out and hear the logic of what I have to say. Because I'm not trying to teach you surface level stuff. Because on the surface, it's true that you do pay more money in interest by keeping your mortgage open instead of paying it off rapidly. That surface level truth is true. But I'm here to tell you guys, you gotta look several layers deep and see the whole picture and not just what's on the surface. It's kind of like when you're playing chess. If you see a good move that looks good for this particular turn, then that may not be your best option. In chess, you want to think ahead. You want to think 2, 3, 5, 10 moves in advance. That's how you outwit your opponent. And the same thing happens in finance. You guys want to be looking at least 2 or 3 stages ahead and not just what's staring you in the face. Now, I will say that this method is not necessarily the best for everyone. Everyone's situation is different. We all have different amounts of a nest egg saved up. We all have different income levels. We're all at a different age. So we're all at different levels of achieving our financial goals. And we all have different levels of risk tolerance. So for some people, it might make sense to actually pay off your mortgage. But for those of you guys that are trying to maximize your money, maximize your net worth, keeping your mortgage intact is definitely the way to go. So let me start explaining. All right, so for argument's sake, let's say that we have a 30-year mortgage at 2.5% interest rate, which is roughly the going interest rate depending on your credit score. And we're taking out a loan for $300,000. That's how much we owe on this house. Now here we're going to see a side-by-side comparison. The numbers on the left are if you are just making the minimum payment. The principal and interest payment on this mortgage over a 30-year duration is $1,185 a month. And if you just make those minimum payments, the house will be paid off after 30 years, and you will have paid roughly $426,000 total. That means you paid off the $300,000 house, and you ultimately were charged about $126,000 in interest. Ouch. Now, if we look at the numbers on the right, this is the same numbers, but assuming we make an additional monthly payment of $500 on top of what is required. So we're trying to pay this house down as rapidly as possible. So now we're making payments of $1,685 every month. So under this set of circumstances, it's not going to take us 30 years to pay off this house. We're actually going to have this house paid off after 18 and a half years. And in this case, we're only paying about $375,000 total for the house. So we have saved about $51,000 in interest by making these additional $500 a month payments. Now here's where the two viewpoints diverge. You have the saver group and you have the investor group. Now Dave Ramsey is one of the saver groups. He says pay down all of your debts, never have any debt, save your money. And he would argue that by doing this method, you are saving an extra $51,000 that you would have otherwise had to pay in interest. And that part's true, but like I said, that's only surface level stuff. Let's look at the opposing viewpoint from the side of the investor. So in order to illustrate this, let's look at two side-by-side comparisons over a 30-year time span. Now, the person like myself that is just putting in just the bare minimum towards paying off their mortgage, it's going to take them the full 30 years in order to pay off their mortgage. But they have an extra $500 a month that they are not putting towards their mortgage payment that the other guy is. So what if we just simply invested that money, that $500 a month, instead of paying down our mortgage? The historic returns in the stock market is roughly 10% per year over the long haul. Now, over a short duration of time, some years are good, some years are bad. The stock market is very volatile in the short term. Some years it's up a lot, some years it's down a lot, down a little, whatever the case may be. But over the long run, it's probably going to come out to roughly 10% per year. So over a 30-year time span, that's a pretty good length of time. We're probably going to get real close to that hypothetical 10% per year return. So if we invested $500 a month for the next 30 years at a 10% rate of return, at the end of 30 years, we would have our home paid off and we would have $1,031,000 in the stock market. Now, if you would put this into a Roth IRA or something like that, that would be completely tax-free money in retirement. But now let's look at the alternative. What if you tried to pay your home down rapidly? Well, over the 30-year lifespan, we're still going to pay off our mortgage entirely. In fact, we're going to do it early. So like I said, it's going to shave off about 11 years and 4 months off of that 30-year mortgage. So it's not going to take you 30 years, it's only going to take you 18 years and change to pay off your mortgage. But during these first 18 and some odd years, you're not able to invest anything into the stock market. Now, once this 18 or 19 years is over, now you have no mortgage whatsoever. So instead of just being able to put $500 a month into the stock market, you're able to put this whole $1,685 a month into the stock market because you have no debt on your house. So you're able to contribute significantly more money per month, but it's not invested for nearly as long. So let's take a look at these numbers. So if we invest the $1,685 a month for 11 1/3 years, that comes out to only about $409,000. Remember, in both instances, our home is still paid off. Now it's just a matter of how much money we have in the stock market. $409,000 in the stock market if we tried to pay off our home fast, and well over $1 million in the stock market if we pay off our loan as slowly as possible and instead let that money sit in the stock market and grow and compound for a full 30 years. So why does it work this way? What's going on with the math? This phenomenon is due to a concept called opportunity cost. And opportunity cost is essentially the cost of doing one method as opposed to doing something else. In this case, it's the cost of paying down your mortgage as opposed to simply investing that money elsewhere. Now, if you'll remember back, the interest rate for mortgages is very, very cheap. Currently, we're getting about 2.5%, give or take, interest on your mortgage. And while that will save you $51,000 over the lifetime of your mortgage by paying it off a little bit faster, you're not able to invest. Because when you're investing, you're gaining roughly 10% per year in the long run, but you're only paying 2.5% in interest. So essentially there's a 7.5% per year spread where you're making a profit by investing this money as opposed to spending it trying to pay down your mortgage. And it's this 7.5% spread that you're gaining each year that allows your returns to be significantly better just by paying the minimal amount towards your mortgage. I mean, think of it this way. If I asked you if I could borrow $2.50 and in return I would give you $10, you would take that deal every time. You're not worried about the $2.50 you gave me. You're worried about the $10 that I'm going to give you. And that's basically what we've got going on here. Now, like I said, this method is not for everyone. If you're not able to actually save and invest, if you don't have the willpower to actually save the money, then yes, definitely pay down your mortgage fast. But if you have a little bit more self-discipline and you're able to actually invest that money, then you're going to get significantly better returns by investing it as opposed to paying down your mortgage. If you found this video useful, be sure to subscribe, leave a comment down below, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.